applicable to decision at hand. It will be ideal if the costs are not only relevant or applicable but also accurate. The concept of relevant cost eliminates unnecessary data that could complicate the decision making process. It means that sometimes the data provides unbelievable that overloaded data and the data which may not be helpful to take a certain amount of decision. At that point of time, maybe it would rather providing a facility to easily take a decision. Instead of that, you maybe create some confusions for taking a decision because of the data may not be simplified. Making correct decision is one of the important tasks of a successful manager. Every decision involves a choice between at least two alternatives. The decision process may be complicated by volume of data, irrelevant data, incomplete information and unlimited alternatives like. So in this case, maybe the volume of data is very huge, the data may not be relevant, the information which you want may not be available there. So in this case, the decision may be very much complicated, and in that regard, the decision should be based only on a relevant information, and that's why the relevant informations would be considered for the analysis of decision making. Relevant information includes the prediction of a future cost and revenues that differ among the alternatives. That means they need to identify for a future planning, and not only even that, they wanted to design a revenues for a future concern. So any cost or benefits that does not differ between alternatives is irrelevant and can be ignored in a decision. All future revenues and or costs that do not differ between the alternatives are irrelevant. So it means that if there would be any irrelevance data, revenues and cost, there would be no difference at all. So to identify which costs are relevant, apply certain steps. 1. Eliminate sunk cost. If you want to identify a relevant cost, you need to actually eliminate the sunk cost. Eliminate cost and benefits that do not differ between alternatives. That means in case of if the cost and revenues and cost and benefits are not differ in case of any alternatives, that should be eliminated. Compare the remaining cost and benefits that is actually happened certain reasons between the alternatives to make a proper decision. So this is what all about the concept of relevant and irrelevant cost. So the next is relevant cost and irrelevant cost characteristics. Relevant and irrelevant cost characteristics are also identified from their ideology, meaning and their definitions. First is relevant costs are future expected cost. The decision is to be implemented in future, and so relevant costs are also to be incurred in future. So here in case of a relevant cost has been considered, it is actually incurred in future. Certainly all future costs are not relevant cost, but all relevant costs are a future cost. So that means it is not necessary that the future cost may be relevant or not, but definitely all relevant costs are definitely in the future cost. Second is it differs between the different decision alternatives. So it means in all the decisions the relevant cost may not be remain same. For the different type of decision, maybe the relevant cost is also changed. So it differs when more than two alternatives are designed or considered. It should be the cost which will not change between the different type of alternatives are to be ignored. It differs when more than two alternatives are considered. Those costs which will not be actually range between the different alternatives are to be ignored. So in this case of a difference between the alternatives. Next is it may not be available for books. All relevant costs are not available have the different type of recording in the books of accounts. For only those expenses are mentioned in books which have already taken place, that means the historical cost, excluding the anticipated cost also. So the next point is relevant costs are cash flows. Those are alternative only that enhance the value of cash resources in future should be accepted. So that means the costs which are very much relevant, very much alternative identified, and if it is a value of cash resources, then it would be considered. The expenses is irrelevant for decision making in which no cash payment is involved. Next is variable cost may be irrelevant. The variable costs are usually relevant cost, and then however such cost may be irrelevant sometimes also. Next, the concept of irrelevant cost is one part of the process for decision making in managerial accounting. In the course of business, the eventual development occur that do not happen to affect the production process directly. So in that sense, whatever the business development has done, then at that type of concern and that type of problems occur, it do not affect any amount of changes directly at the time of production process. So however, this development may or may not be denominated in monetary terms. Thus, such developments are called irrelevant cost, and the irrelevant costs are actually may not be denominated in the monetary concern sometimes. Some characteristics are that they do not differ between different decisions alternatives, and it may be in money terms or not. Sometimes it may not be valued in money also. The concept is actually in management accounting system, each product usually charged with a portion of indirect cost which are not traceable to the direct product. So at that time we need to identify that the some indirect costs which may not be traceable would be identified concern for the relevant or irrelevant requirement. Hence, the cost data drawn from the cost accounting system are often not relevant as they are historical cost. Here, now the important point is, start with this first, is marginal costing. It includes only variable cost. It means that the fixed cost does not include in case of the calculation of marginal costing. At any particular level of output, a change in the total cost by increase or decrease of one unit is called marginal cost, which we have already discussed in the chapter of marginal costing. Marginal costing is extremely usable for decision making. As I already mentioned in the beginning of the chapter, there are two important methods and techniques for decision making. One is marginal costing, other one is a standard costing. In fact, it is a major tool for decision making. Another one is sunk cost. If I want to tell you a simple word for sunk cost is, the sunk cost means the cost which are incurred cannot be recovered. It is called sunk cost. It means it refers to the money already spent and permanently lost. That means the cost which are incurred once, it is already considered as an expense and it's permanently lost. Some costs are past, opportunity costs are partially. So that means at that time they feel there is an opportunity and we need to adopt this opportunity and then incur that expenses. But in future they don't have an idea whether this cost would be helpful in the future or not. Therefore, it should be considered irrelevant to future decision making because of they were identified the problems at that point of time and they took a decision, but they did not see for the future planning, and that's why the sunk cost is irrelevant cost for a future decision. Sunk costs are those costs which do not change under a given circumstances and do not play any role in decision making process, and that's why it is also known as committed cost and historical cost. So next is opportunity cost. Opportunity cost is all about to identify the opportunity which was actually foregone is taken into the consideration where the alternative are compared. So there are many alternatives, and from the alternatives you need to identify that which opportunity has to be clicked right now, and on the basis of that opportunity, if you incurred any part of the expenditures and incurred the cost, that is called opportunity cost. This opportunity cost is the value of a next best alternative. So in other words, it is an opportunity cost lost by diversion of input factor from one use to another. So why it is one use to another? Because of once that the particular option has been designed, particular structure has been designed, and that's why you input something, and that input would be actually given from one to another. So inputs has been put in the one factor, and we will be getting in some ideas, some decisions out of it. That would be another concern. So the opportunity cost is a pure decision making cost. It is an imputed cost which does not require any cash payout. So the definition, if you want to say in case of an opportunity cost, that is the value of a benefit sacrifice in favor of alternative course of action. So here imputed cost comes from what one could have made from an asset if you had used in a different way. So that means any expenses that is borne indirectly, it is concerned a notional cost. Next is fixed cost. The cost which always remains fixed irrespective of production volume is known as fixed cost. That means it is assumed that up to a certain level of a production or a certain level of a capacity, this cost may not be different. So this cost remains constant whether the production activity has been increased or decreased. It does not mean that the fixed costs are always fixed at all the time. It may be changed, but the change not at every period of time. It's changed at certain period of time. So for short-term managerial decision making, fixed cost may be relevant or irrelevant. From the viewpoint of a profit planning control, it is useful to subdivide fixed cost into two types. One is committed fixed cost and the another one is discretionary fixed cost. Next is variable cost. The cost which varies, that production volume is known as variable cost. That means the cost has been varied on the basis of the output, on the basis of the production level, it is a variable cost. It suggests that this cost varies with the increase or decrease of output or production. It is so because the input of raw material is used in the exact quantities needed for production process. Though it is believed that all variable costs are relevant. Why? Because of this cost is directly affected to production value. So that is why it's actually not so, because if variable costs were depending on different alternatives for decision making process. Next is out-of-pocket cost. Out-of-pocket costs are those expenses or those costs which are current cash payments to the outsiders. That means it would be paid to the third party payments. All these explicit costs like a payment of rent, wages, salaries, other type of transportation expenses, these are the costs, is a best example for out-of-pocket cost. And this cost is useful while taking decisions like make or buy and price fixation during depreciation. Next is book cost. Book cost is, I just want to tell you, which is not at all involved with any amount of cash payments. That means those costs which are actually not at all involved